Welcome back to QAV America, Tony, episode 23. We're recording this on the 30th of September, Australian time, 2025. Been a couple of weeks since we've talked about the United States. Tony, I know that you're an avid follower of the Wall Street Journal. Anything going on? Anything happened in the United States in the last couple of weeks? I haven't seen anything about the United States for a couple of weeks in the news. Nothing going on.
Apparently, the contract to service the UN elevators or escalators is up for renegotiation. That's about it, I think.
Well, the story there is that it was, did you see that? Why the escalator stopped?
I've seen a number of reasons why the escalator stopped, including a photographer pressed the stop button.
I read it was Trump's photographer who was going backwards up it, whose foot got caught in it, and it jammed and stopped. And then the teleprompter was apparently run by the White House, who screwed up the teleprompter. So it was his own fails from his own team, apparently. That's what I read in the New York Times, the failing New York Times. Well, Tony, I thought I would, that's what he calls it, doesn't he? I don't know if they're failing or not. Probably. Large media. I wanted to, before we get into my pulled pork this week, I just wanted to do a quick recap of how our US portfolio is doing and talk about what's going on with some of the other companies that we've covered over the last few months on this show, how they're doing. So let me bring up our US portfolio. As I've said many times before, it's been an interesting year for our portfolio in the US. It was doing 3 times the market by the end of last year, but then after Trump got elected, it has not had a good year. So all time, our portfolio in the US has been running for just over 2 years now. I started at 20th of September 2023. Over that period of time, it's up 65% versus the S&P 500, which is up slightly less than 50%. So it's doing reasonably better than the S&P 500, but not double like we're doing in the US, and certainly not like triple. Like by the end of 2024, our US portfolio was doing 3 times as good as the S&P 500. So it hasn't had as good a year, 2025. Year to date, it's actually down 12% versus the S&P 500 up 13%. But as we know, that's how it goes. We go up, we go down, but generally we go up more than we go down over the long haul.
I just want
some of the...
sorry, can I jump in here? There was I know the show was released in the US last week, which was a discussion of the QAV Bible, and it mentioned that my long-term returns were 19.5% CAGR, and that's was certainly the case back when we started QAV, but it's not the case now. So I just wanted to highlight that for people. Don't want to mislead them. And that's why we use the term double market, because my returns are twice the market, or roughly twice the market still, but the market's moved since then. So I just don't want to mislead people by posting a number out there. It's more instructive to look at the long term and to expect to get something like twice the index if you successfully invest according to what I've been doing for a long time.
So I'm just looking up my list of pulled porks that I've done over the last 6 months. I can't remember who I did in episode 21. MEOH. Yeah, right. I don't have an update on MEOH. But for the rest, like I was saying to you on our last Australian show, when I'm on some of the value investing forums in the US, like the subreddits, that kind of stuff, a lot of people talking about how they can't find anything to buy, value investing is dead. We saw an article from some guy saying that, people saying they can't find anything, all the value's gone. And I'm like, what is your problem? Because I did a US buy list at the end of last week, and there was like 200 companies that were on the buy list, which means that, that's what our buy list is showing us as being undervalued at the moment, well-performing businesses that are undervalued. But just the list of companies that I've talked about on this show since March Zim was the first one that I did on the 13th of March. It is down 26% since I talked about it. But then in order of shows that we've done, so the next one was CX, Chemex. It's up 68%. Danaos, DAC, is up 16% since we talked about it. Canadian Imperial Bank is up 23%. Enel Chile is down 10%. Ford Motor Company is up 8. IHS is up 37. JXN is up 16. Oryx Corporation is up 27. Precision Drilling is up 18. POSCO is up 5. ZEP Corporation, ZEP Health, is up 1,511% since we talked about it on the 11th of July. Sasol is up 43%. Bausch Health Company's up 16. Seneca up 9%. Grey Media up 40%. We talked about that on the 7th of August. It's up 40% in less than 8 weeks, in 7 weeks. An old television station. Titan Machinery's up 11%. Kimball Electronics is up 7%. Suzano is down 2% since we talked about it at the beginning of this month. And then MEOH, I can have a quick look on Yahoo Finance. Let's see, how's MEOH doing?
Maybe you should post our podcast to this Reddit value sub investors club or whatever it's called.
Oh, I do.
You do?
I do. And I just get abused for being an idiot. MEOH.
It's easy to handle abuse when you're a rich idiot, though, isn't it? A successful idiot.
MEOH is up a couple of points since we talked about it. Actually, it's about the same. It was about $39 when we talked about it. It's still about $39. Methanex Corporation. So anyway, so there's, I don't know what people's problem is. I don't know what kind of value investing they're doing where they can't find value when we're finding value all over the place. So speaking of that,
and the other point to make on that, Cam, sorry to interrupt, is that you're not even picking the top stock in the buy list. You're just picking out stocks which are interesting that we don't have examples of in Australia, for example, or just look worthy of a bit of investigation. So it's kind of a random selection from the buy list that you're picking.
Yeah, I'm looking for something that's, different to because as we keep saying every episode, there's a lot of shipping companies, a lot of financial services companies, and I just don't want to talk about the same thing every week. Well, we've talked about a lot of dirty businesses in this show over the last 6 months, Tony, and this time I'm going to do dirty healthcare. Not because I want to highlight the company we're talking about as dirty, although they have had a very long list of scandals and fines and things like that, but just because the healthcare system in the US is just a mess. Now, obviously we're Australian and we have a very different healthcare system, but I would not want to be a patient in the US for-profit healthcare system. And that's what I'm going to talk about today is one of the companies over there. CYH is the name of the company. Community Health System, CHS it's known as, but the ticker code is CYH. And I often hear Americans in person and online, I'm married to an American, spent quite a lot of time over there. They think they have the best healthcare in the world for some reason.
Really?
You often hear American politicians, particularly Republicans, stand up and say we have the best healthcare in the world. And I hate to break it to Americans, but that is just not the case. Compared with other rich countries, the US has worse population health and the most expensive health care system in the world. Hold on. I just hit the wrong button here. Okay. Just to give you an indication, bottom line is, despite far higher spending per capita, the US has worse population health. In 2023, US life expectancy was 78.4 years versus 82.5 in peer nations, the lowest among the group, and every US state sits below the peer average. Life expectancy gap is big and stubborn. The US rebounded post-pandemic, but still trails by 4.1 years in 2023. That gap predates COVID and reflects higher premature deaths from overdoses, violence, and chronic disease. Infant deaths are higher. Maternal mortality is higher. Avoidable deaths trend the wrong way. Where the US does shine, it ranks second on care process, prevention, safety, coordination, patient engagement, a sign that it can deliver high quality clinical episodes even if population outcomes lag. And for several cancers, for example, breast cancer, US 5-year survival is among the best internationally. So, but the cost context is the US spent $13,432 per person on healthcare in 2023, about double the comparable country average, and still posted the worst overall performance in the latest international scorecard. So that just gives you an indication of where it sits healthcare outcomes wise. So wouldn't want to be a patient, but maybe it's okay to be an investor, because we've talked about a lot of dirty businesses over the years, Sasol, etc. We've talked about some companies and industries with a pretty bad track record. But at the end of the day, they could be good investments, and this could be one of those. I do want to flag, though, before I get into the details, that CYH, from our perspective, is currently a Josephine, meaning that its share price is not above the buy line, but it was 1 cent away from the buy line when I was doing this analysis yesterday. It was at $3.18. The buy price was $3.19. I think overnight it dropped down to $3.14. So it's a little bit off its buy line. But the other thing I want to flag is that it took a big hit a few months ago. It dropped like 28% a few months ago when it came out with some bad results, and the CEO, longtime CEO, announced his resignation. He actually leaves today, the 30th of September, is his departure date. The CFO is going to be the interim CEO, but they've been recovering since they had this big drop a few months ago, and they're nearly above the buy line again, as I said. I'll give you the high level, though. The prop CAF, price to operating cash flow, is 0.9. So that's why we're talking about them today. They're insanely cheap looking at them from a cash flow perspective. And these guys are huge. Their market cap is only 445 million, but the enterprise value is 11.39 billion, and their revenue last year was 12.65 billion. They're a Fortune 500 company based in Franklin, Tennessee. Community Health Systems, as I said, is the name of the company. They were the largest provider of general hospital healthcare services in the United States in terms of care facilities. In 2014, they had around 200 hospitals, but as of 2025, they have about 70 hospitals, or 71 maybe, in 14 states, with 10,000 plus beds and 1,000 plus sites of care. So they've sold off a lot of their network over the last 10 years or so. They run general acute care hospitals, ERs, surgical imaging, physician practices, urgent care, cancer centers, and more. Think local hospital operator at national scale, but focused on mid-sized markets. They've bought up a lot of stuff, sold off a lot too eventually, but they sort of did a big roll-up of medical facilities around the country for years. They were formed in 1985 by executives of an earlier for-profit hospital chain, or a number of hospital chains. They IPO'd in 1991, went private in 1996, then relisted in 2000. Then they bought Triad Hospitals in 2007 for $6.8 billion, which doubled their footprint. Then they spun a bunch out into a company called Quorum Health in 2016, which later went bankrupt in sort of April 2020 as COVID started to hit, and got delisted. But they've had a bunch of scandals, these guys. A lot of billing / false claims settlements, and a 2014 cyber breach. They're reputationally, they've got a lot of baggage, a lot of issues. I'm not sure if the CEO leaving is going to really help with that, but I guess it's a start. They've had a lot of pivots, a lot of crises, a lot of M&A, and a lot of trying to get rid of debt, which might, if interest rates come down, that might help them refinance some of their debt this year. But it's kind of a bit of a messy business and a messy history. Bunch of scandals, as I said. They've had to pay multiple fines to the US DOJ due to their billing practices, allegations of defrauding the US government, something called the False Claims Act, basically claiming money from the government for stuff that they shouldn't have been claiming money for. Um, Allegations of breach of fiduciary duty by CYH executives, allegations of fraud with regards to financial projections. I know we tend to have a governance red flag with a lot of the companies that we look at in Australia. These guys would, in the past, a lot of these things are over the last 10 years. So
Right.
they're not necessarily the last year or so. I'm talking about 2014, 2017,
Right.
dates like that. But yeah, not, it's like not a very clean bill of health in terms of at least the presentation of how they run the business. They've settled a lot of these things. So these were allegations that they ended up in lawsuits, either from other hospitals or from governments or from patients. They've also had lawsuits filed against them for alleged predatory liens practices, where hospitals file for liens rather than bill individuals' health insurers, resulting in massive fees for patients. So they go and take a lien over your car if you have a bill, a healthcare bill that you haven't paid.
Yeah.
But American
Car,
healthcare.
kidney. Which one do
Yeah.
I need more? Yeah. Okay.
Reality, though, is for this company is revenue in hospital services is paid by managed care, about 57%, Medicaid, 21%, Medicare, 21%, self-pay, 1%, and their trailing 12-month revenue sits around 12.6 billion. It's down a bit from where it was sort of peak COVID. And it's a complex business. I'll get into sort of the breakup of the financials a little bit later on, but the way that these guys make money is a mishmash of different things. That 28% drop, though, in July, I just wanted to touch on a little bit. So they trimmed their full year guidance down to 1.45 billion, down from 1.55 billion. At the same time, they announced a CEO transition. So there was this double whack of lowering their outlook and leadership uncertainty, dropped 25 to 32% in a day and finished about a quarter lower. So that was a big whack for investors at the time, but it's recovered since then.
I think also too, Ken, if I can
So,
interject, it's it's CEO transitions can be a good thing. I don't know this
yeah.
company well enough to know what will happen with this one, but it's often a time when a new CEO comes in and they clear the deck, so to speak. So investors should go into this with their eyes open, in that it's possible that a new CEO will come in and try and take every possible write down, every possible restructure they can in their first year. So they may even lose money in their first year. So they can set themselves up to achieve their bonuses meaningfully in the following years. So just be aware of that, I guess, if you're looking at investing in this company.
Although the caveat on that is, I'd say that the incoming interim CEO anyway is a lifer. He's been there since 1997. He was the
Oh, okay.
president and CFO.
So probably not
So
applicable to
it's
him
not
then.
like he can't play the three envelope strategy and blame all of their woes on the outgoing CEO, Tim Hingtgen, Hingtgen. Your guess is as good as mine as how we provide. It's like Trump trying to say acetaminophen. Aceta, aceta,
Probably
aceta,
carbonate.
aceta. Yeah, we'll just call it Tylenol. Yeah.
Yeah.
So Tim Tylenol, who's retiring today. Yeah. So he's the incoming guy, Hammonds. I don't know if he's going to be the long-term CEO, but he's the interim CEO as of tomorrow.
Right. Yep.
So if they get in a new guy, some fresh blood, he might make some big changes. What spooked investors last time, apart from the CEO transition, was management pointed to weaker volumes in a softer acuity mix. Acuity mix, new term for me, acuity is how sick or complex the patients are. So you have high complexity cases and low complexity cases.
But they've been too
And
good
high
at
complexity
curing people. They're not coming back in.
or people aren't sick enough, I think, is the issue. Well, you're not really sick enough. We can't make enough money out of you because you've just got, I don't know, you got a cold, or you broke your nose at kung fu like I did on the weekend. Yeah, my doctor went, it's fine, it'll heal, go away, leave me alone. Versus long-term care, so they make more money out of higher acuity cases, but their acuity mix has been softening, apparently. Costs are sticky. Your labor, your equipment, all the other costs that you have, power, etc., real estate costs. But margins compress when the price per case drops. So that was one of the issues. The CEO is officially leaving for personal reasons. Nothing to do with
Hope he isn't sick.
bad numbers. No, to spend more time with his family and
Right. Okay.
pursue personal dreams, he said. Like
What could be
personal
a bigger
goals,
dream
personal
than
objectives.
healing people on a mass scale?
The $8 million he took home last year. Yeah, I don't know.
Mm-hmm.
Maybe once more. So what's working and why it's cheap? Look, it's generating a lot of cash. As I said before, the price to operating cash flow is less than 1, which is, we get a lot of those on this show. The prop caps that we see come through are insane. So there's a combination of things. Some of the things that go into the mix of hospitals making money or healthcare businesses making money over there. One is throughput, obviously, how many paying episodes you push through the system. ER visits, admissions, surgery, scans, births, the more bums in beds, more cash, higher volume. Then there's the payer mix. Who's paying the bill determines your margins. The rough rule of thumb for US hospitals, apparently, is that commercial insurance pays best. Medicare, 65 and up, pays less. Medicaid, which is for low-income people, pays even less. And then self-paid or uninsured often pay nothing. I think that's emergency rooms and that kind of thing. There are some things you can get done in emergency where you don't have to pay in the US. So you want to have more commercial work than Medicare, Medicaid works. If it tilts towards Medicaid or self-pay, when people then don't pay and you need to take a lien over their car, your revenue per patient falls. Then there's rate discipline.
Can you imagine the doctor in Australia taking a lien over someone's car for not paying their bill? That would just be front page news. They'd be drummed out of the business.
Yeah. Like it's just, like a lot of the stuff we see in the US, like it's insanity, like gun laws, just insanity. I was in the Mormon subreddit or the ex-Mormon subreddit because of this guy that just attacked. Sorry, what's your question?
No, what's the question? The ex-Mormon subreddit, were they for the people? They're the people who were shot on the weekend in the Mormon church.
The
ex-Mormons.
Dark, Tony, dark. No, people talking about like the alleged shooter of Charlie Kirk. Came from a Mormon family in Utah. Now there was an attack on a Mormon church.
Hang on. The alleged shooter?
Yeah, well, I don't think he's been found guilty yet by a court of law. Right. So he's the alleged shooter. Yeah. And then there was an attack on a Mormon church over the weekend. So I was reading some of the commentary on that. And people were defending the gun laws in the US and how taking away guns doesn't do anything. And I'm like, Australia here. Australia would like to weigh in on that. Took away our guns, semi-automatic weapons anyway, in 1996. We have more guns now in the country than we had in pre-1996. Did you know that?
I did not.
More
No.
guns here now, yeah. But not semi-automatic. And the ones that we do have now are usually organised crime, and they're not getting into the hands of mass shooters. So we haven't had a mass shooting really since 1996. So, yes, saying it just doesn't work might be a little bit simplistic. Anyway, back to healthcare. Rate discipline, how hard you negotiate and defend prices with insurers, better contracts, those sorts of things comes into play. How you manage your working capital, how you collect from people that owe you money, all of that kind of stuff. Waste less, run leaner supply rooms, don't overstock, don't overpay, or don't pay your vendors earlier than you have to, all of the usual sort of working capital things that you have to do. Uncompensated care, charity care, and bad debt, you want to drive that down. Your acuity case mix that I mentioned before. Agency nurse spend. Apparently they use a lot of temp nurses at very high hourly rates, so you want to tame that as much as you can. Keeping your length of stay, or LOS, efficient. Get patients home as soon as possible. Get them out. Get sick of bums in beds.
You're going through the sort of third and fourth page of the Hippocratic Oath, the very the not so widely known sections.
Fine print.
Get your charitable work down. Get the patient out quickly.
Yeah.
Mm.
And then there's the competitive edge. I mentioned these guys do a lot of stuff in non-metro areas. So that's kind of their moat. If they have a moat, they have, a lot of facilities in regional areas where you then have physician relationships, fewer direct competitors than you might get in big city clusters. So some of their portfolio pruning over the last 10 years has been to, I think, focus their energies more in these areas where they can be more competitive than they might be in areas where there are more healthcare providers. So that's sort of the mix-up of the business. It's quite complicated, and some of the reasons why it's cheap, they're carrying a lot of debt. They've got, I can't remember, billions of dollars of debt. But potential interest rate cuts coming through in the US, so they might be able to refinance some of that. They're also selling off assets, selling off hospitals. They've got some other deals on the table at the moment. They're trying to sell off more stuff, and they can use that to pay down debt. Some of the other issues, there's this reimbursement risk in the US election cycle. So Washington and state capitals apparently set big chunks of hospital pricing. Medicare rules, Medicaid rules, all this sort of stuff. So when you have elections, new state and federal governments can come in and, fudge the amount of money that these healthcare providers can get their hands on, pay less, pay differently, pay later. So they're dealing with that sort of mix. And then their investors are a little bit scared of the for-profit boom-bust optics in this sector. Apparently it's got a track record of, like as I mentioned before, Quorum going bankrupt during COVID. They spun off a bunch of their businesses into this other listed company that then went bankrupt. So investors are a little bit wary on this, and possibly for a bunch of good reasons. But, from our perspective, it's very cheap and it's generating a lot of cash still. And the numbers, which I'll run through in a minute, look pretty good. There are some red flags, but if the cash engine stays real and they're able to divest or deleverage more, it could look even better in the future. So the QAV score is 0.7, which is pretty good. Average daily trade is about 8 million, pretty strong. Quality rank on Stockopedia is a 61. We score anything that's 60 or above. The stock rank doesn't score because we only score for a 90 and the stock rank is 86. So it's slightly below our cutoff there. But they do score for the F score, the Petrovsky Financial Health Score, which is pretty strong. They get a 7 for their F score. We'll score anything that's 4.5 or above. They get a 7. So despite all of that debt, their F score is actually pretty solid. They don't score for price being less than IV number 1 or IV number 2. They don't score for price being less than book value growth is not positive. They don't score for P less than yield because they don't have a dividend. They don't score for yield as greater than bank debt for the same reason. So it's largely based around PropCAF. Tony is the main score. They had 11 numbers that we could score for, and they got a 7 out of that. So quality score of 64%.
I think one of the things I'll just chip in here is that I don't think they're making a profit at the moment either, at a net profit line.
Well, that would be why.
Yeah, so they're losing money. Although I think it's forecast to get back to break even this half or next half. So even though they're throwing off lots of cash, it's being spent, and it looks like it's being spent on capex. So that's either equipment or, I guess, building hospitals, which I don't know what part of the cycle we're at with their capex. It might be ending soon, or it might be a fairly average year this year. So we're really basing our liking for the stock on its cash flow, really. And then we would
if I look at
hope the new management can boost margins and reduce costs and get back to a net profit basis.
if you look at their profit history, 2019 they lost 675 million. Profitable in 2020, 2021, 2022, key COVID years. And then they started losing money again from 2023 onwards. But their loss in 2024 was 516 million. The estimate for this year is down to 36 million, and for 2026 it's 17.8 million. So it's like the forecasts are that it's turning around. Their book value is negative because of the size of their debt, I guess. So that's why the price to book is dodgy. But yeah,
there's some risk there. But my question for
Yeah.
you, Cam, is if America spends twice as much on healthcare per person than comparable nations, why can't a hospital make money? That just seems who's making money in the system if it's not the healthcare provider?
Well, the CEO took home an $8 million paycheck, so he is.
Right.
Yeah, well, I think we know that doctors over there make insane incomes, right, compared to doctors in the rest of the developed world.
Do they really?
Doctors, well, yeah, I think so. Like doctors in Australia aren't making most. I mean, you make it some surgeons or plastic surgeons or people like that are making millions of dollars a year here, but you don't expect your GP or most of your doctors here to be making a ton of money, right? They do okay, but they're not millionaires, you know. I think doctors in the US make a lot of money, and I think insurance companies make a lot of money. It's probably where a lot of it goes. So I don't know, Tony. So that's an interesting one. So they're generating a lot of cash flow, but they're not profitable because they're sinking a lot of money into capex and paying off their debt and all that kind of stuff. So I don't know. How do you feel about a business like that?
I like a business throwing off lots of cash, and I'd be trusting and hoping that the change in management, even though it's an insider, sounds like he's interim, so there might be a change in management to an outsider coming up, would clear up their problems. So they seem to be clearing up anyway from a profit point of view. We have seen cases of this in our Australian investing, and it hasn't worried me too much because it's my experience that if a business is throwing off a ton of cash, it solves a lot of problems. Pays down debt, it funds capex. It's a big pot to play with to solve a lot of problems. And if they have had problems, and maybe they were COVID related, I don't know, then they're getting back to break even, and the cash will help them get back to profit, I'm fairly sure.
Yeah. So at the end of the day, prop calf is what we really care about.
Yeah, and as I've said time and time again, I don't know this company. I haven't delved into it as much as you have. I don't know why their profit is negative, but it could be for accounting reasons. It could be for, the fact that they're over providing for certain things like bad debts or whatever. So as we say, profit is as much a management decision as it is an accounting decision. So
Yeah.
that's another reason why I focus on cash flow. So it's got heaps of cash. I view strong cash flow as risk mitigation. We're getting paid back by the operating cash flow in under a year if we put our money into this company, and that means our exposure is quite low in terms of risk going forward. If this company was profitable again, it would trade on a much higher multiple, obviously, uh, and you'd see a material rise in the share price for it.
So a lot of the money is going to debt servicing. 2024 interest rate expense was 860 million. Operating income was 542 million on 12.6 billion of revenue. So their margins are low, sort of a 4.3% margin. So interest alone wipes out operating profit even before taxes and things like that. Then they had in 2024 301 million of impairment and loss on asset sales, plus 486 million depreciation and amortization. So that's where a lot of the net loss is coming from.
Debt's a worry, but they're paying it down. They've got the cash to pay it down. The impairment would be non-cash, so that's once off, and it doesn't affect cash flow. So those things will just, with time, go, or the impairment will go away. Won't be there next half. So,
but yeah, as you said, profit is an accounting decision, right?
no, profit is a management decision. Cash flow is an accounting decision. Yeah. There are so many.
How accounting determines that is a management decision.
Correct. But, CapEx is a management decision. How much you spend on CapEx is decided by management. And they could probably make the company more profitable or all profitable tomorrow by just withholding a bit of CapEx. So it's always a trade-off, which is why I prefer cash flow as a metric to value a company rather than profit.
Yeah. All right. Well, that is all I've really got, Tony, on these guys. CYH, Community Health. Do your own research, people, but it's an interesting business, I think. And good luck not having to get involved in. Hope you don't end up as a patient. As you
I
know,
was a
my
patient
son
once
Taylor lives over there. But
in the US, and it's not cheap.
yeah. Taylor, my son, who's been living in LA for 6 months, has been trying to get health insurance over there and can't get it. He's like all of the hurdles that he needs to jump through
Yeah.
as a foreign citizen who works for himself and runs his own business. Trying to get healthcare over there has been a nightmare. He's been trying for months and just can't get it. So if anything happens to him, he just needs to get on a plane and come back here to see a doctor, really.
And they might not let him on if he's, coughing and sneezing and red and running a temperature. But look, I think, the one risk I think that could be coming for this company is a capital raise. If they want to clear their debt quickly, they may actually go to the market and ask for money from shareholders, which would dilute people. But if it puts the company on a profitable footing, it might be worth it. So just bear that in mind if someone's looking at buying this stock.
Thank you, Tony.
Thanks, Ken.
Talk to you next week.
All right. That'd be NYSE.